Alright, so for this video I'm going to be sharing my model, how I use them, what's the framework, what's the guidelines, and I've been showcasing this model as well for the past few live streams. And if you like what you saw on the live streams, you would like this video. Right, so let's get started. Right here. If you notice, I have a card right here. So this card basically tells me what I can do. Okay. The most important part about this model is having a daily bias. Now, how do you get a daily bias? You get them from the weekly bias. How do you do that? How do you get good at it? You practice it. Or you go study more ICT. And that is the only thing that you need. The daily bias. Okay? That is the only thing that you need to improve at. Because everything out there, I assume that you have learned before in terms of entry models and stuff like that, all the basic stuff, because I'll be only using the basic stuff. Okay? Now, dropping down into the 1 hour chart, we are going to focus on Thursday, right? Because that was the last trade that I took on live stream. We're going to focus my model here. And the second requirement for this model is you can only trade in the direction of your daily bias. The third thing is you can only enter a trade if the entry provided is below both opening prices, the midnight open and the daily candles opening price. Okay, so you have two filters now, right? You can only trade in the direction, in the same direction as the daily bias, and then you can only have an entry below the daily opening price and the midnight opening price. The third requirement is your entry has to be in discount relative to the current dealing range. Okay. Now, what's the guidelines? You use the 1 hour time frame to see if it has traded below Asia's opening price. Okay, so let's have context first. For context for Thursday, we are bullish. Right, I have it right here. We are bullish. Okay, we wait for the 1 hour candle time frame to trade below Asia's opening. Asia's low. That is the minimum requirement. It has to trade below Asia's low. Okay, so once it does so, drop down into the 15 minutes. Use the structure on the 15 minutes to determine your entries. Alright, so what you want to see on the 15 minutes? You want to see a change in the state of delivery. How do you do that? Look for swing highs to be taken out. That's pretty simple, right? It's either you look for swing highs to be taken out or you look for bearish fair value gaps to be disrespected on the 15 minute time frame. And only then you start to look for your model, for your entry, sorry. So over here, we have the first swing high taken up. So at 5:30, you can technically start to look for entries, long entries, right? So what is the dealing range right now? It would be from this low to this high. How do you find or anchor dealing ranges correctly? Go study ICT. He mentions this before. Okay, now right here you can see that price offered discount before trading higher. Okay, let's just say you're not awake during London like me. You're only entering the market in the New York AM session. So I assume you start your your chart time at 9 o'clock. This is what you would have seen. Okay, so you know that we are going long. We have taken out stops on the 15 minutes. We have traded higher above this swing high. So what's the dealing range right now? From this low to this high. Okay, and then you wait for what? 9:30. Okay, you wait for 9:30. Actually, you don't have to do that, but you can do that because right now you already have your dealing range. Okay, now let's just say you waited for 9:30 and you see that price took out this high. You move your fibs higher and then you determine the range again. Okay, if you notice or if you have watched the Thursday's price action, we traded above these highs here before printing the downside of the week. Just to make sure. It didn't print lower first, then go higher. It went up higher first, and then came lower. Alright? Therefore, I have this range annotated right here. The next thing to do, look for PD arrays within discount. Right here, what do we see? Over here. 3 PD arrays that I utilized, starting from the strongest to the weakest. Okay? Inversion fair value gaps. Right here, can we find an inversion fair value gap? Yes, on the 50 minutes. Right here. Okay? Now, I'm going to give you a very simple tip right here. Not every inversion fair value gap is strong. How do you select the correct ones? Okay, for me, I use inversion fair value gaps that has been utilized before to form important highs and lows. Dropping down to 5 minutes, you'll be able to see what I mean. Okay? Now, that 15 minutes inversion fair value gap was not utilized to take out any highs and lows. If you drop it down to the 1 minute, you'll be able to see. Right here on the 5 minutes, we have this inversion fair value gap. Why did I cherry pick this inversion fair value gap? Seems like cherry picking, right? But if you watch the live stream, I'm looking at this and I explained why. Correct? But anyways, I'm going to explain here. We utilize this fair value gap to send the price higher to form an important high before taking out sell stops. Price then traded above this high that formed this low. This lows. So this was used prior. When we closed back above, it did not retest until this candle right here. Right, we have all the swing lows. It did not retest until this level right here. Until this candle right here at 9:35. Notice how when we closed below the first time here, we retested it to send the price into a lower low. Came back up, retest again, and then we trade above, closing back above. So you do expect price, when it comes back down, you do expect this to be a support level if it is to trade higher, correct? The daily bias here comes in play because you're expecting bullish prices. You are not looking for bearish targets. So basic ICT traders might look for this low because it's the data lows. Bias is more important than your targets, and it's more important than market structure, because if your daily bias is wrong, you're going to take losses even though the market structure looks correct. Okay? Now, inversion fair value gaps are your true support resistance. I can't believe I'm using these words, but it is. Okay? So look at where it falls in. Right within OTE range. ICT taught this before. I'm not going to go through this again. If you are interested in OTE, watch ICT. Okay? Now, OTE range. Look at where we tagged. Right in the middle of the OTE range. How perfect is that? Right? So, you would want your entries to be below 50%. Best case scenario within the OTE range. And that's where your entry would be. At the high of the inversion fair value gap. Where's the stop? The data lows. Right? If you can't find the last down close candle that took out sell stops, like right here, we don't have it. I don't count this as the last down close candle. I don't do that. You can put your stops down here. What do you look for? Projections. It has to be above Asia's high, correct? So for projections, you use the first leg. Don't use the second one. Use the first leg of OT that it has offered discount before as your projections. So what is the nearest projection above Asia's high? 1. Look at where the candle stops at 1 before retracing. Look for that as your target. Now, if you're just a trader starting off, you can look for easy low hanging fruit targets, Asia's high. That will bring you to about 1.6. Or you can hold for 2 right here, because the maximum that you're looking for would be here. Obviously, if you're more experienced, you'll be looking for equal highs, which should be somewhere above the 1.5. Okay, so now let's just use the low hanging fruit objective. This would be your best case scenario. Do you have to get this? No, you can look for 2, right? So let's just say you don't have experience in the markets and you don't want to receive any drawdowns after just missing your, after it misses your exit and then it retraces. You don't want to tolerate that retracement. Then look for 2R, and you just exit the trade. Okay, now what do you want to see when price trades into this inversion fair value gaps? There are things to look for. Okay, you do not want bodies to close below the inversion fair value gap. That's pretty obvious. And you want to see price react aggressively away from your inversion fair value gaps. You do not want to see price spending time inside that inversion fair value gap. Okay? What's the next step? Move your stops to your entry as soon as a short-term high is taken out. So what is short-term high? Basically heads and shoulders, the shoulders. Okay, that is your short-term high. So short-term high is taken out right here at this candle. Move your stops to break even, or to this swing low right here. If your entry wasn't perfect, like your entry was at a high, then move your stops here. So now you're basically close to break even. I mean, close to zero risk. That's how advantageous this model is. Okay. If you want to have a really tight stop loss, really tight stop loss, you can use this low right here as your stops. Why? Remember how ICT mentions that a candle, he mentions that it takes 3 candles to form fair value gaps. Okay, so you basically use the third candle's highs and lows, depending on whether you're bullish or bearish. However, let's just say you have a consecutive fair value gap in terms of like something like this, consecutive fair value gaps, then obviously you have to factor in the second fair value gap. And then the candle, the correct candle for this particular fair value gap, that would be this candle's low. I mean, that's just an example. Right here. Okay. Now, this is for traders that enjoy really tight stop losses, but I don't usually recommend this, but you can do this. Okay. Now, if you do this, obviously your risk to reward is going to be very high. And yeah, you can work out the math yourself. So these are the things that you look for once it tags your entry. Okay. Now, what is the next rule here? What is the next thing that you see here? The entry is below the daily open and the midnight open. Midnight open is right here. Daily open is right here. What is the advantage that you get buying below daily open and midnight open? Let's go back into basics. Open, high, low, and close. This is a candle's anatomy. I'm not really sure how is that word pronounced. I forgot. Okay, but anyways, here's the candle. Open, low, expansion, retrace, close. This is a bullish candle basically. Okay, bearish candle, just reverse it. So imagine this is a daily candle. Buying below the opening price means that you're buying down here. This would be the most extreme discount that you can ever get for the daily candles expansion. Okay, I'm really putting you at a very good spot right here by buying below the daily opening price and below the midnight opening price. If midnight is right here, best to get something below. But usually, I mean, not usually, but in this example here, midnight was higher, so you're buying in a very, very deep discount to look for higher prices. Okay, now the probability of you getting this setup wrong is only one thing. I mean, it's very low because you only have one thing that makes you wrong, which is you're wrong on your daily bias. Because if you're wrong on your daily bias, it means that you're predicting an up close candle, but instead they gave you a down close candle. That is how you're wrong. Okay? You can further determine this by London's price action. Has London taken out Asia's high? If it has not taken out Asia's high, you're probably going to be correct. There's a very high chance you're going to be correct. Okay? But if you see London taking out Asia's high before driving lower, right here you have to be slightly more cautious, but you can still take the same setup. It's just that it could be a seek and destroy day. Okay? Now, what does this model offers? It offers you a lot of comfort because you can move your stops to break even, and at the same time it is a very logical level as well. Why is that so? Because you're actually trading turtle soups without knowing it. Okay? Why? And how could you say that? Why not? You're basically looking for stop hunts to be taken. However, your entry is so refined that you're catching the low of the turtle soup. It is so refined right here. Okay? Now, because it is a turtle soup setup, what do you look for turtle soups? And what are the signature of turtle soups? Okay? Now I'm going to tell you. Turtle soups are the best entries because they are the most aggressive. They do not spend time below those lows. Okay? That is the signature of turtle soups. Second thing is that it is usually the leg that gives you the most energetic price action towards your objective. Right? Because you're buying the stop hunt before higher prices. Okay? You're basically acting as the smart money right here. Now this is too perfect for an entry that for me to be sharing here, but it is what it is. It doesn't mean that when I share it, you would be 100% correct. Because you're going to get wrong for your daily bias, especially if you're new, because it requires a lot of forward testing. You will not be able to get your daily bias by backtesting. Let me just tell you this. Okay? The only way to improve your daily bias is forward testing. Alright? Now, so let me just go back to the point. It gives you the maximum comfort level for trading. The other thing is that it provides you with a very good risk to reward. So you don't even have to worry about taking losses because you would have a very good risk to reward. Right? Can you imagine buying the lows? How bad of a risk to reward can you expect? Very little, right? So you have comfort, you have the best risk to reward, and the most important part is this model filters out a lot of bad trades. Remember how many times you're trying to short on a bullish day or you're trying to buy on a very bearish day? Those are the times whereby you usually take losses and then you try to reverse your positions and then found out that, oh, it's going for a retracement after you reversed your bias. Okay, so when you only trade in one single direction and you're only taking one trade setup a day, capturing the daily range, it is very difficult for you to lose. Okay? If you lose consecutively with this model, you have to work on your daily bias. That just can't be helped. right? So you have only one requirement to use this model. You have to be really good at your daily bias. What if I don't know what's the bias for that particular day? Then obviously you do not trade. Right? You do not trade. If you don't have a bias, don't trade. It is very simple. Right? What is the time for the expansion to play out? Okay? Since for example, if you're just playing during New York, your move has to be completed by 11:30. That is the latest. The latest 11:30. Okay? Especially if London has already provided the opportunity for the first leg's discount, like in this example here. Okay, so if New York presents the first leg of discount, you can hold the trade up till 2 p.m. Okay, you're not going to be afraid of the lunchtime retracement and stuff like that. But obviously, if you don't want the lunchtime retracement, get out before that, which is 11:30. Okay, but I'm just saying, if London does not provide this first initial retracement, look for your targets in terms of your higher time frame targets to be met prior to 2 p.m. Okay, if London has already offered the first leg's discount, look for your targets to be met prior to 11:30, which is what we have right here. Before 11:30, all the targets were met, and then we have a retracement. Okay, and there you go. This is the model, right? I actually gave you a very good model. I think it's one of the best out there, if not the best. I mean, you can just compare it. The only drawback for this model is that it doesn't print every single day. Sometimes it doesn't even print it doesn't print a single time in a week. So for this model, it's only good for people or for traders who can have the discipline and patience not to trade every day. And you will do very, very well if you have that discipline and patience. Because if you can withstand not trading every single day, you're going to overcome your losses easier. You're not going to have a very hard time. You're not going to go down into a mental drawdown, stuff like that. Your mental capital would be always in abundance. When you have a strong and readily available mental capital, you can hold on to trades. You can buy when price is coming down. Can you imagine setting your orders here and then you see the stop hunt right here on Asia's high, and then after that it comes strongly back down, closing the candle below this green candle, and your entry is right here? Can you handle that? When you don't have a very high and readily available mental capital? Obviously not. You're going to manual stop out yourself right here at the lows as you are buying it, as you're entering it, and then watch this price happen, and then you're going to chase, and then you're going to withstand this retracement and probably going to stop you out. Okay, that is what is going to happen. So that is the only drawback for this model here, and if you can do it, it can really give you really, really good results, because you're basically acting like a market maker right here. You're basically, okay, sorry, not market maker, but you're basically acting as smart money, because you're buying the lows, selling the highs. All right. And you're buying stop hunts as well. How perfect can this entry get? How perfect? Just look back the past few days, or just look back through my live streams or my past executions for the past few days, because I only reviewed this model for the most recent live streams. I've been using this model for my live account, and you can just imagine, right? But anyways, I hope you find this insightful, right? Because even if you don't use this model here, you're trading the lower time frame, you still want to remain as a scalper. If you apply the same rules, you're going to have a very good time scalping the markets. Okay? You might not hold for the entire daily range. Let's just say you go down into the 1 minute. Okay, let's just say you trade, what's the most popular model entry right now? Inversion fair value gaps, am I right? So if you just trade basically off of inversion fair value gaps and you're looking for entries at least below the midnight opening price, look at what it would give you. Okay, so bearish fair value gap right here, this would be your inversion setup, correct? Once the candle closes above, don't chase it, wait for price to come back down. For your re-entry, your stops would be down here, or this candle's low if you really want to be like ICT, tightening your stops so tight, you can put it down here and then look at the price. Low resistance liquidity runs. Okay, second entry over here, even though this one would not be recommended because it's not below midnight opening, it's the same. Wait for a close above and then wait for a retest. Don't enter market right here. Okay, wait for a retest, and that way you can better manage your stop loss placements and you will not get faked out or pressured out of your trade. Okay, look at how it responds right here, and then higher prices. Okay, so you can use this, you can refine it, you can incorporate it into your model, up to you. But this is the only thing that I'm emphasizing here. Daily bias and buying below opening and midnight open. Daily open and midnight open if you're long. Selling above daily and midnight open if you're short. And obviously if you're scalping, you can have an entry in between these two prices, midnight open and daily open. That's for scalps, okay? That is for scalps, which is why I annotated this example right here. For scalps, you don't look for higher time frame objectives because you're going to get retracements like this and you're probably going to manual stop out yourself. Or you're going to move the stops, tighten your stop loss so tight that it comes back and stops you at break even and then move higher. So this is the reason why you only look for scalps if you're entering in between these two lines here. Right here I have this annotated. However, if you have an entry below these two prices, you can sit back, relax, watch the prices go to your levels on the higher time frames, and just watch the PNL rise. Okay, now inversions, yes, I do agree, they are very strong, but when it's used like this, I don't think it's the most efficient way to use it. I think my model is the most efficient way to use inversion fair value gaps, because you're actually capturing the low of impulses or capturing the high of impulses. That cannot be done like this. Okay, so you can just look back test yourself the examples of this inversion fair value gap entries, the way I use it. You will be able to see how it was able to call, or how it was able to be the high of the days, high of the sessions, highs and lows of days, highs and lows of sessions, highs and lows of impulses. You can backtest it and see it for yourself. Other blocks, they come seldom, but when they do, it would usually be coupled with this inversion fair value gap. So usually there's always an inversion fair value gaps. Only when it doesn't have inversion fair value gaps, then you use the order block. And proportion order blocks, that is for scalping. I don't usually use this for this particular model, right? Because it doesn't really appear because you're buying the lows. Proportion order blocks usually happen right after the lows are formed. Okay. And that's basically it for this model right here. Alright, so if you enjoyed this video, do leave a like. If you have any questions, please write them down and ask those questions when I'm in a live streaming session. Because if your question is very complicated, I'm definitely not going to type an essay to answer your question. Okay? I am not the type of person that types, and I'm also not the person that presents. So that's why you don't see PowerPoint slides, and that's why you don't see a clear presentation. What you see is charts and random drawings and some annotations. That's it. Okay? So with this, I hope you enjoyed this, and I hope that you can incorporate some of the things that I shared right here. It is all basically ICT, right? If you study ICT long enough, you'll be able to understand what I'm trying to say, or you would be able to figure it out yourself. You'll be able to figure them out yourself, okay? So that's pretty much it. Have a great day, and I'll talk to you again.